Tyler, one thing we're going to do here today, we're going to go into our Coach's Corner segment where we have one of the coaches that are here on the show, break a trade down step by step by step. And the great Tyler Craig is here, options and directional trader extraordinaire. I have no idea what you're going to build, Tyler, but I'm very excited about it. Go ahead, Tyler, you're up, my friend.
Okay, so this is maybe not.
Right, hold on.
Maddie?
Hold on.
I have a speculation.
Hold
I
on,
don't think
hold
Tim's
on.
gonna like it.
Tim, Tyler has a job to do here, and you did not lay that out.
Oh, yeah, that's right.
Tyler's
Explain
job.
it.
Tyler's job in the Coach's Corner is to try to convince Cody, myself, you, and Mark to take the trade. And then we will either agree or disagree with the analysis.
I love it. So, Tyler, you are going to make your argument. We are going to judge your trade, directly, I am sure.
Which, Tyler, that's what we love doing, is judging.
Oh, yeah. Well, I will lead with an arrogant statement. If you don't like this trade, it says more about you than it says anything about me. I'm just going to put that out there. Okay?
I love setting the standard there.
All right.
Oh my God! You just said three Justice brothers. You told them that it says more. And all three just said, "Well, we'll see about that."
All three started hating on the trade.
That was not the right sales pitch to the audience here.
You know what though? I want to make it entertaining, and I stand by that.
I like it. I like the confidence, Ty.
Okay. All right. So look, I'm not going to do like a classic high base breakout, a little bull retracement. Software stocks have been just eating the world. IGV is a software ETF. So we know software is hot, and you very rarely get the opportunity to buy a leader in a leading industry at a discount. And I don't want to bottom fish unless the chart looks good. So I was scanning while y'all were talking crypto, and I came across CRM perking up a little bit here, right? We know Salesforce is one of the best names in this space. You take a look at the weekly chart. You've got a nice longer term uptrend, pulled back a little bit after earnings. I think that is temporary. I think eventually the earnings come back, or at least enough where the market likes it. So I've been looking for a reason to buy the dip. And I think today is the first reason you've had since this thing gapped lower on earnings. So you take a look at the daily, here's the down gap on earnings. And since then, we actually consider this for a bear trade because it had a little low base, but it did not break support. Essentially, it filled the earnings gap from 2 quarters ago. And that gap fill became support. Okay, so I've got a pretty good confirmation that we're seeing support come into play here. But if you want more evidence, you wait for buyers to return and jam the thing above resistance. Today is the first candle taking out a prior pivot high. This is the first time we've essentially broken a pivot high since like September. So I got a change in character on a stock I wanted to buy on a dip anyways. It's tested support multiple times. You're breaking resistance today. I understand that there are potential resistance levels, but there are always potential overhead resistance levels when you're going to buy a longer term pullback like this. So pattern wise, that's my case for fishing for a bottom here in CRM. If we were talking about this yesterday, we'd have said you got to have some kind of trigger. I think today's your trigger, taking out that prior pivot high. In a second, I'll tell you the 2 different ways I would trade it on the option side. But y'all got any questions on the technical setup?
On the technical side, very quickly, you got to like the constructive nature of the support bounce that you had, a little bit of a double bottom. It had that big red candle on the 9th of December coming into that support level at 220. I mean, and then it just stuck to landing, and you got to be impressed by that. Right, you got to be impressed by that. Had all the momentum to the downside, had a negative reaction to earnings, tested underneath 220, tested it multiple times, had momentum coming into that 220, and then 4 or 5 days straight of consolidation. And really, you got to like the defensive nature on that. Look at that 9 EMA now crossing up over, getting close to that 20 EMA. You can start to see momentum coming into that. And I like that 230 channel on the breakout. Not only is that feeling some gap analysis, but you got a previous pivot there on 1030 as well as 11.2. you have that pivot there, 2-point pivot when the market was a little bit overextended in that neutrality. You know, it pivoted there. If you can close above 230 and you can get above that, and you can close above that 20-day moving average, I think you got to call that confirmation on that reversal pivot. My point is, technically, I do agree with you so far. I'm on board so far, Ty.
I thought the big red candle and then the gap down on earnings. The big red candle was the announcement of purchasing slack, and then earnings was the details behind them purchasing slack. So I don't think they missed on earnings. I think it was just the nature of acquisitions.
They didn't miss on earnings, but the market went down. Like,
it's the nature of acquisitions where I think that they did a good investment by purchasing slack, and from that point, plus the technicals, I so far I'm in.
I'm open. I'm open to it.
I will tell you, I am not on the call side, like straight up call option though.
No, I want to hear how you'll trade
have
it.
Something a little bit of mitigating the risk, but I am interested in the option.
Yeah, I can see the bullish nature, but how?
All right, so
it's a classic bottoming pattern that I trade all the time. Right now, I'd like it to be lower on the chart, but that's the OX case. But this pattern, consolidation, bears have 4 or 5 chances to send it lower, form support, start to clear moving average. This is a classic bottoming pattern for me.
Okay,
so
we're on board so far, Ty.
All right, so in building the option trade, I got a couple things to consider. One variable that I use, which, spoiler alert, that's what the next Trading Justice newsletter is going to be about, is we're going to talk about how to pick an option strategy, the definitive guide to strategy selection. So getting a little taste of that today. When I look at the price of options, I like to use implied volatility as a quick back of the envelope signal as to whether they're cheap or expensive. This one is not particularly expensive, and it's not especially cheap. It's kind of in the middle of the road here. So I'm going to say we could go either way on this. I think if you want to go higher probability, you can sell some out of the money put spreads. I'll give you the one that I would do here in just a second. But if you want a longer term recovery play on this, I think you can go a couple months out, buy some bull call spreads, get you a nice little risk reward trade that way as well. So I'm anchoring on the chart here under, 215, 210. If I can sell put spreads down here, I like it. Might even be able to do Jan, which is only really 3 weeks out, but let's see. So I'm going to go out. I'm going to sell, can I do 215? I might have to go to February. 215, 210 credit spread. I'm under support. So 215 would be my stop. I'm getting 87 cents, 87 on 413. And your 21% return for about 3 weeks of time. If you want to bet this doesn't take out the low here, get you a 23% return to bet it stays above 215 for the next 3 weeks.
So give me the numbers.
Hey, Ty, can you go back to the option chain real quick?
Yeah.
Yep.
What were your deltas on that? Can you?
215 is a 20 delta.
20 delta.
This is a 20 delta bull put spread. Selling the 215, buying the 210, just a simple $5 wide. So I got about an 80% probability of profit, and I'm making 80.
Very quick point of clarification. You're working in January, right? 24 days?
Jan monthly, yeah, 24 days out. Got a 21% return.
I think Matt and I are both doing the same thing, by the way. We're running our numbers on our spreadsheet.
We're running our numbers.
Yeah, that's right. Give me the chart if you can. And let's see here. What's the ATR on this thing?
ATR is 446.
So your two proposals are either bull call spread or bull put spread?
Yes.
Okay.
I'll get to the bull call here in a second.
Kai,
but
I feel like
I like the support level you're selling under in the short term.
Matty, did your mic move on you a little bit?
It might have. Can you hear me now?
Much better. Yep.
Yeah.
Okay. Sorry about that, boys. I like the support level you're selling under. That is a short-term support level, obviously. Do you have concern about the probability of touch here? The probability of touch is 48%. I know the probability of expiration being right around 78%, 79%, but that's still a fairly substantial management decision you might have here.
Mhm.
Now, I like your technical edge, and the option probability does not take that into account here. I just don't know if you're selling deep enough here.
If I want to sell deep enough, then I got to go out to Feb. So the issue, the reason that's coming up is we're about that 3-week time frame. If we were 5 weeks out, we'd be fine. You start to get 3 weeks to the front month and selling a high probability credit spread. If the vol's not high enough,
you're trying to take advantage of the short-term technical pricing range and saying, okay, I have a technical edge on the short term. I'm taking advantage of that where the option probability is not.
Correct.
Okay.
Yeah. So anytime you sell a 20 delta naked put or credit spread, your probability of touch is always, 45%.
Yeah,
right.
Well, and the reason I said it was 48%, that's a little higher than it normally is. And it's probably due to some of the volatile nature of CRM and ATR distances. I didn't get to fill out the entire spreadsheet there. I like the edge. I'm just a little concerned on that, but you're getting 21% return on that. You can't complain too much. On the bull call side here, Ty, can you give me those? Have you walked through that yet?
Nope, not yet.
Let's do that one.
What was the credit on the put first? 85?
85.
85.
But actually, no, hang on. In my defense, it was 87. It was 87 3 minutes ago.
It was
but
87.
Y'all are hemming and hawing so much. Now it's 85.
Yeah, traders take action. All right. Okay. So I like it. I don't love it. I like it. I don't love it. Especially, let's say it does violate 220. I mean, at 205, you have just such a massive support level. Such a massive support level right there under that 200-day moving average. I love your technical edge there. I do think there may be maybe we go out a little bit more time frame, or maybe we sell a lesser delta, see if we can get underneath that 205 level, or even at 205 by 200. But again, that's just nitpicking. Let's hear the bull call side of it.
The bull call, I want to go out a little bit in time because, I want to give this time to make a recovery. And I do acknowledge there's a couple of overhead resistance levels. So again, I'd rather it hit my target sooner and wish I bought less time than do a 3-week bull call and wish I bought more time, right? So I'd go out to February on this. You're about 60 days out. And if you want to have a nice little risk reward on a bull call, I like buying maybe the first strike out of the money and selling maybe the second or third strike out. So, I think ultimately 250, 260 is not an unrealistic target over a couple of months. In fact, your stretch goal is maybe 270 if this thing fully recovers. But I don't think I need to go that crazy. So I think I could just buy the 240 call and sell the 250. Pay about $3 for a $10 spread. You can make almost 7. So, I got a bull call here where I'm risking 320 to make 680. I can make a 200% return if we get above 250 in 2 months, which I think is totally doable.
Marky, Judge.
I already placed my trade. I took the 215, 210. I got sold.
You like the bull put side of it, Mark?
I like the January bull put. This is a classic bottoming pattern that I sell bull puts on all the time. Tyler, you had me at hello. So it was a really easy sell for me because I love this pattern. Now, I do think, the probability of touch is negated, and there's no way to mathematically by the support level on the floor. Obviously, the market has to turn. I don't think, unless the market turns itself, I think this trade is good. I got sold easy on this one, so I did the 215, 210.
See, and I'm not on the bull put side here.
I'm not either.
I think the bull put side is too close in my personal opinion.
I think you're taking too much risk and you have too much management decisions.
I like the bull call setup out of the two. And I actually like the technical setup here. I think there's definitely an opportunity from a chart perspective. Tyler, when you brought this chart up, I would have almost guaranteed you were going to show me a diagonal call spread because of the low implied volatility that you identified early in the spread. And this is the great thing about option trading, right? You can match a strategy to what you think you're seeing.
Yeah.
The bull put is qualified. I ran the numbers on my side. We have a thing called tackle theta research. We're not going to go too far into it right now, but the ROI numbers look good. I'm a little bit concerned about the cushion to the to the strike at 215. Just even visually here, if support fails, that probably would whipsaw in the money real quick, and you'd have a management decision that could be pretty tough pretty quick. So in my opinion, I would go with the call side. I think it's a better setup.
Yeah, I would go with the call side too, Tim. I know that short-term support at 220 is good, but I like it from a directional perspective. I don't think it's strong enough to take on that risk on probability of touch, especially if it violates 220. You just got major support underneath 205. If you can get underneath 205, take a little bit less risk. I just think the 215 by 210 is too aggressive here, especially with where volatility is. This is the lowest point volatility has been literally since July. And so, yeah, you're getting 85 cents on the credit, and that's decent. But again, you got a 48% probability of touch, which is typically a little bit high for a 2021 type delta. With where volatility is, I think you take advantage of the call side, and I'd like a 240 by 250. I like it. You got liquidity there. It looks good. I think you take the aggressive action here.
And Cody, I know you got to bounce here real quick, but what are your thoughts? Just any last ones for this trade setup?
Definitely like the trade setup. I'm actually biased because I'm already in a trade on CRM. And I actually
beat that book, Cody. Come on.
I went straight puts whenever I did it. I got puts down at 200, and they've been paying me quite nicely.
No, I like any put side underneath that starts with the selling of the put at 205. Like I like
the 200 period moving average, and I sold these like 60 days out, so I've had these for some time, and I got a really nice credit on them. And with this turnaround that we're having, like I'm already in the trade, and so I'm biased. So as soon as he brought it up, it's like.
And can I say something very quickly on that? Ty, if you were to say a naked put at 210, I would have been interested because you have that major support. But a bull put, you don't want that to be touched. You don't want that to be even looked upon. You don't want that bull put to be, in the zone of the price action in any capacity, and you certainly don't want to get stopped out above a major support zone right there at 205. So a naked put at 210, yeah, I could see that because you have that major support level at 205. I just don't like that put side on the bull put above that support level. But on the call side, where volatility is, combine that with your technical analysis, I do like that call spread.
Tyler?
Hey, we all part friends, gentlemen. I love this game. Yeah, nice. Well done.